Welcome to Capital Link's company presentation series.
Good day to everybody. I am Nicholas Bornozis, President of Capital Link, and I would like to welcome you to the 2025 Capital Link Company Presentation Series. In this series, company management highlights the company's current operations, business development, growth prospects, and sector outlook. Today, we're pleased to have with us the senior management team of EuroDry Ltd. Specifically, Mr. Aristides Pittas, Chairman and CEO, and Dr. Aslidis, CFO and Treasurer. Let me briefly introduce the company. EuroDry is a dry bulk shipping company which was formed in 2018 as a spin-off from EuroSeas Ltd, and the company currently operates a fleet of 13 vessels, soon to be expanded to 15 vessels, with a cargo capacity of 1 million deadweight tons. In terms of the companies that shares are trading on NASDAQ under the ticker symbol EDRY. In terms of logistics, we will start with a brief company presentation followed by live Q&A. Please note that participants can submit their questions through the Q&A button at the bottom of the screen anytime during the webinar, and your questions will be replied during the Q&A session. Before we begin the webinar, a reminder of the traditional disclaimer that this discussion is purely for informational and educational purposes. It is not intended to be advice, legal advice or investment advice or advice of any kind, and Capital Link obviously bears no responsibility for it. And as a further disclosure, we have the privilege to work with EuroDry on investor relations. Now, let's begin the discussion. I'd like to turn the floor over to Mr. Aristides Pittas, the CEO.
Good morning, ladies and gentlemen. EuroDry is, as Nikos Bornozis said, a dry bulk company which was formed in 2018 when we spun out the dry bulk vessels out of EuroSeas. We operate a fleet which consists of 13 vessels. Actually, soon it will be 12 vessels in the water, because we recently, today actually, we announced that we are selling our elder dry bulk vessel, a 2000-built Panamax ship. And we also have, again, as Nico said, 2 new building Ultramax vessel orders, which will be delivered in Q3 of 2027. My family has been in shipping for 4 generations, so we've been in shipping for a very long time, and we first listed EuroSeas in 2005. Then, as I said, with a combined fleet of dry bulk and container ships, which we later realized was not what the market wanted. The market wanted specific sectors to be specific companies so that they can decide themselves if they want to invest in dry bulk or containers or tankers or whatever. Leveraging the tradition, or the family tradition, we have now formed EuroDry 7 years ago. The vessels that we own are all managed by Eurobulk, our family management company, which has expertise in running such ships for many, many years. The company is vertically integrated and carries very strong relationships with charterers, suppliers, bankers, and all other industry participants. The next slide shows you our current fleet of 2 Kamsarmax vessels, 5 Ultramax vessels, Supramax vessel, and 5 elder Panamax ships. The eldest of the 5, the Tassos, is the one that we've agreed to dispose of next month. It's a vessel whose special survey was due, and we decided that it was best to sell before passing the special survey and use the funds as a buffer that will help us grow the fleet later on when we feel prices are right with younger vessels. As I said, we have placed the orders for these two 63,500 Ultramax vessels that will be delivered in Q2 and Q3 of 2027. Our aim within EuroDry is to renew the fleet gradually by selling the elder vessels and buying newer ones at the opportune time, because we all know that shipping is a very cyclical business, and we have to exploit this cyclicality and buy vessels when prices are reasonable. This means that reasonable prices, low prices, you get them when the market is low, and we will see if this year will present some further growth opportunities. This growth can be financed, of course, organically, as we have been doing up to now, but it can also be financed and faster if one cooperates with others, does joint ventures, as we did very, very recently, back in 2023, when we bought 3 Ultramax vessels, and in 2 of those we teamed up with some Norwegian investors that were provided through NRP Capital in Norway, who took about 40% of those ships. That enabled us to buy more ships and grow the fleet and have some synergies that come with the introduction of these Norwegian ship owners who may help further in the further growth. So hopefully at some point our share price will also help in this growth. But for that to happen, we really need to see the valuation improving significantly to approach NAV valuations. Let me talk a little bit about the market fundamentals, because what we've seen during the last 4 or 5 months has been a significant drop in charter rates, which was not really expected to happen that much. It happened for a couple of reasons. The main reason being that demand from China didn't really pick up as expected and as it usually does in the fourth quarter. And of course, now there's been this hesitance from people and markets to really move following the election of Donald Trump, the discussion about the imposition of tariffs, and generally people and the markets are quite uncertain about the prospects. The demand side is the issue here, because the supply side looks quite promising. As you can see in this graph, the order book for new ships is about 10-11%, This is historically very low if you look at the last 20 years and also previously. So we are not expecting too many ships to come into the market. So we will have to see if the demand recovers, which at some point it should, to drive the market further north. But at this point in time, I feel that we are in a wait-and-see situation. You can see here what this has done to prices of ships. And of course, you know, following the extremely high prices that we saw in 2005 to 2009 and the collapse afterwards, we saw prices, both second-hand and new building ships, remaining extremely low for the vast majority of the time within the decade of 2010 and 2020. That was the time when the huge order book that we saw in the previous graph was being delivered. And therefore flooded the market with too many vessels. And of course that resulted in this very poor 10 years that we had up to 2020, when starting from COVID onwards, the markets recovered, the prices started recovering, and both second-hand and new building prices improved. At this point, as you can see, new building prices remain stable at a level where we don't feel they can go too much south. To build a ship today has become more expensive, both because of the increase in the prices of the material and the steel, but also labor costs, even in China, which nowadays produces more of the ships. So we don't feel prices of new builds can go significantly lower. Second-hand prices, which are affected by charter rates, can drop further, and they have been dropping significantly over the last 4 or 5 months. In this slide, it's generally showing that the growth of the fleet has been quite low over the last few years. The expected growth of the fleet in 2025, 26, and 27, as you can see on the right-hand side of the graph, is a manageable level. You can't compare the three future projections for 2025, 2026, and 2027 with the previous ones. The previous ones also have the scrapping and removals in them. So the actual deliveries, the actual growth in the fleet in the 3 years to come is going to be lower than what it has historically been. And here we just show in this slide what are the factors that affect demand growth. Demand growth follows closely, as we all know, the global GDP growth, with spikes either way, depending on other parameters. The China slowdown has the effect of affecting demand for bulkers quite significantly, and the projections are that this will continue to be like that for this year at least. There is always the potential changes that come due to the geopolitical events. Steam coal probably has peaked, but still the requirements are huge in Asia, so we will have to see that. Every year we say that steam coal has peaked, and it always ends up a little bit higher, but we will see. Trade routes, we have to see how the tariffs, if they are affected. All these inefficiencies that might happen are always positive for distances traveled and for shipping in generally. Inefficiencies help us. Obviously, we saw last year the effects of the Suez Canal closing. This probably will be reversed this year. We see the effects of the decarbonization efforts, which are leading to slower speeds, thus increasing demand. So there's so many factors affecting the end result for demand, so it's very difficult to predict how that will go. The next slide summarizes our view on what happened in 2024. And in the next two bullet points, we talk about what can happen in 2025. And as I've already said, the demand outlook is very difficult to predict. Right now, people think that the growth is going to be quite slow. It will depend on what Chinese dry bulk imports end up being. It will depend on the US trade policy. And of course, it will depend on whether the ceasefire in Gaza holds. And all these things will determine how demand grows. The positive thing is the supply side, which, as we saw, is not going to grow substantially. It's going to be less than 3%, especially if you deduct scrapping. It can be around 2% growth. So everything will depend on what demand will be. So I think that summarizes a little bit our general strategy and our market view. And I will let Tassos take you through the financials of EuroDry itself.
Thank you, Aristides. In that context of relatively low market that Aristides described, we have taken the position on our chartering strategy of not committing our vessels for long periods. The slide that I put on shows you when, up to what time in 2025 our charters are booked on contracts. And you can see that other than the current employment, in very limited cases, only in 2 cases, we have charters that go beyond the middle of the year, potentially. And even in those cases, the rate of those charters, I'm referring to these 2 charters, is linked to a market index. So really, we're fully exposed to the market. And I think given the circumstances, this is the right thing to do. You don't want to commit your tonnage at the bottom of the market. It is not a surprise that given that the relatively poor state of the market for most part of 2024, our results for the first 9 months were not positive. We did have total revenues of a little more than 46 million, but we had to record a loss of $2.34 per share on a diluted basis. And that was primarily due, of course, to the market, but also to the fact that seeing the low market, we brought forward the dry docking of 2 ships. They were due to be dry docked in 2025. We felt to take advantage of the low market, and we brought it forward to be done and be available to charter the ships, hopefully higher rates next year. And that affected the results of this year. On average, in the first 9 months that we published our results, we earned an average time charter rate of a little more than $13,000 per vessel per day. And we, at the same time, exercised our share repurchase program, using from its initiation up to the end of the 3rd quarter, 5 million to repurchase about 11% of our outstanding stock. For the fourth quarter, results will come later this month, but again, it would be no surprise if I say that we expect to have not a great quarter, because again, the fourth quarter market-wise has been even lower than the first 9 months of 2024. A couple of highlights on our debt and balance sheet I will give you now. This shows our debt and our break-even level. Our debt is shown as of the end of the year. It's easy to roll forward our debt. So as of the end of last year, we had about 108 million of debt against a market value for our fleet that we estimated to be a little more than 200 million, 222 million, which translates to about just a bit less than 50% loan-to-value ratio. Given the state of the market, I think that is a quite conservative ratio. We're at the very almost at the bottom of the market. So that is on our debt side and our financing side. I mean, we recently, as I think mentioned earlier, or it was in the chart in the slides earlier, we refinanced 4 of our ships, increasing our near-term liquidity. The bottom part of this slide shows you our estimated cash flow break-even for the next 12 months, including obviously our operating expenses, G&A expenses, dry docking expenses, which would have very few. Only one vessel is scheduled to be dry docked in 2025, so that's why we have a relatively low level of dry docking expenses. Our interest expense and our loan repayments, all these figures come to about $11,600 per vessel per day. So as long as the market is above $12,500 to account for commissions and some off-hire time, then we should be cash flow positive in 2025. A little bit on our balance sheet. Again, these figures, the bars on the left are as of the end of September. They show in simplistic forms the components of our balance sheet. We have the vessels and some cash. On our asset side, we have our debt, some other small liabilities, including our minority shareholders, and of course the book value of our shareholders on the liability side. If you put all those next to each other, we have vessels at book value of 194 million as of the end of September. But as of the end of the year, we had about 222, as I mentioned, million market value for our fleet. If we use that figure, then we estimate that our net asset value per share is about $45. It's about $45, which is significantly higher than what our stock trades recently, which is in the $10 to $12 range. Let me then provide some closing points from our brief remarks. What reasons we see one should invest in EuroDry? There are 2 main reasons. One has to do with the industry and mainly with the supply side. Supply side, as Aristides explained, is at historically low levels. The order book has been at the very low levels for 3 or 4 years. It has picked up a bit, but still it's very low by historical standards. So that provides the foundation for any recovery in demand to be translated to rates. Our fleet is appropriately positioned to take advantage of that by being fully exposed to the market. So that's reason number 1. The second reason is that we are very cheap. I mentioned in the previous slide that we trade in the range of $10 to $12 per share, and our NAV we estimated to be in the 40-something dollar range. So we trade at a huge discount to NAV. I realize that we are a small cap stock with low trading volume. However, if the market turns up, if the demand improves, that tide will lift all boats. It will lift our boat more than others. So people who own our stock should experience a significantly higher appreciation than other dry bulk stocks. So this is the second reason I believe our stock is quite attractive. There's a bunch of other reasons that had to do with our history, the size of vessels that we focus. We focus in owning the medium range of sizes, which is more flexible in terms of providing trading possibilities. At the same time, because it's the largest ships in their sectors, the ones we have, provide certain economies of scale. We run our fleet quite efficiently. We're on one of the lowest cost operators in the public markets. And Aristides already mentioned about our experience and of his family, of course, but all of the executives as well in operating in the public and shipping markets. I will stop here, and I think Aristides will open the floor for questions if there are any.
Okay, how did the 25-year survey cost impact the decision to scrap Tassos?
Me?
How much? No, yeah, yes,
By the
yes.
way, we can stop sharing the screen now.
Okay.
Okay, so indeed, the cost was around $2.2 million. The ship was 25 years old, so we decided that it was not worth keeping. You know, the ships are sold for scrap when the markets are poor and their dry dock is imminent. That's really when a ship owner takes a decision whether to scrap or not an old vessel. The average scrapping age has been 22 years old in good markets, but even 28 years old in 28 years old in good markets, but 22-year-old in a bad market. 25 is about the average price historically. The average age. Next question is, your stock is trading at a 70 to 80% discount to NAV. Increasing your buybacks would improve NAV per share, liquidity, and stock price. Do you plan to increase buybacks or tender offer shares? What would need to happen for you to increase your buybacks? Buybacks, indeed, we've already done 5 million, which for the company size is quite significant, but we have another 5 million already agreed to do. Our problem is the low liquidity of the stock, which makes it difficult to execute. And also, we don't want, to reduce the stock tremendously. Our family.
The shares traded tremendously, yeah.
Yes, and the shares available tremendously. Our family obviously is not a seller, and our shareholding is increasing. So it's something that we follow, and we will increase as much as the increase in liquidity in the stock helps.
Yeah, it is true that there are certain constraints about executing a stock buyback program. People have to match your bid. You cannot match the bid of the seller, etc. And as Aristides said, the low liquidity prevents us from utilizing it more.
So what can you do? Very nice question. What can you do to change the undervaluation of your company on the stock market? I think discussions like this, where we explain the strengths of the company and the value in the company, and also as people realize that this is a company in which my family owns close to 60%, i.e. is something that we care tremendously about and want to improve its valuation. I think this is very important. Obviously, investors want to see results, and I don't expect to see a significant improvement until we start having profits again, which implies a higher market than today's market. But I think that the value is in the company, and that value will be realized, and it will be realized for all investors in time. Is there a plan to sell the older ships to your Euroholding spin-off later on? It is one of the ideas. There is no decision taken or plan made yet, but this is something that may happen. It has to make sense both for EuroDry and Euroholdings to do it at some point in time, and it may. Would it make more sense to buy back shares and even sell more ships into the current high market? The market is not high, so ideally we are not sellers, definitely, of all the younger vessels. The market is at a low level, although prices have not corrected substantially, so I see that's why you're making that point. But we think that we will see a good market at some point within the next few years. The low supply of ships, I think, is a guarantee that we will see this improvement in the markets. But we need to see the move in the demand, which is very difficult to predict. How positive, if at all, is the bauxite trade and the new iron ore exports from the new mine in West Africa? They are both positive. The fact that there is more material around which needs to be transported is always positive. Also, these increased production capacities will lead to lower prices for the minerals themselves, which is again a positive. When cargo is cheap, people buy more of it. So these are positive events, but they cannot move the market alone.
More directly, bauxite trade affects the Capesize market, but still that is positive for the overall market, right?
Yes, mostly the Guinea market is mostly on Capes. Time charter rates are well below cash costs on many assets. Why are you still operating these assets instead of idling them until the time charter equivalent rate environment rebounds? To idle a ship is a costly exercise. So it takes time, and if you want to idle it properly and remove all the crew, and then when you want to reactivate it, bring back crew and pass through surveys and all that, is a significant cost. If one feels that the market today is at around operating cost level, so it's okay to operate your ship today. You make your operating costs, but you don't make any profits or repay loans if you have or whatever. But we remember that the first quarter is historically, cyclically, a very low quarter. Let's wait and see what happens in the second quarter. I think we might see an improvement in charter rates. Not fantastic, but an improvement. Can you explain the impact of the upcoming Simandou mine on your fleet? I think I answered that question. Can you explain your strategy with the other older ships at current weak rates? Again, I think I talked about that. Our intention is to effect a gradual renewal of the fleet when the opportunities are right. At what point does it make sense to just keep the ship sitting idle? We discussed that. What are the most common routes your vessels take? It's really worldwide. It's really worldwide. With an old fleet continuing large losses per share, almost none of your fleet contracted past Q1 25 and low cash balance. Please explain how the company plans to reverse its dramatically negative performance and trends. What is your daily cash burn? It is true that 2024 was a year where we had small losses, I think every quarter, at least
Every quarter, yes.
every quarter. 2024 was a year that we had many dry dockings.
And we brought forward some dry dockings. I mentioned that.
Which we even brought forward. So in 2025, we have just one dry docking for the whole year. And we had been positioning ourselves for a much better market. We have to see where rates will settle. The rates that we are seeing today are indeed very low, but cyclically and historically in Q1, they are always very low. So let's see where that goes. We need, what do we need?
11,600, as we saw the slide, is our cash flow break even per day. So if you have to make an assumption about what rate you're going to earn. If you earn about 12,500, then you are just covering your cash needs. Anything below that would be a cash burn. Anything above that would be a contribution to your bottom line, cash-wise.
So are there currently any consolidation opportunities under consideration? Nothing specific at this point. Nothing specific to report. We have more questions. Should we expect the scrapping of the Starlight, Irini, and Blessed Luck in 2029, Santa Cruz in 2030? This is the main idea, that they will go until the fifth special survey. But everything depends on the market. You have to be open, listen to the market, make your projections, and decide if it's worth passing a special survey or not. If the market was good, the Tassos would pass its special survey and could operate further. Technically, I think we pride ourselves that we manage older vessels very efficiently and effectively, and with only slightly higher costs than for younger ships. What's the company view on dividends? Well, to be able to pay dividends, we have to have profits, and the last year we haven't had any. Our general view on dividends is that we would like to be paying a decent dividend, but it has not been possible up to now.
To merge back EuroDry into Eurosys?
No, this is not going to happen. We think that our investor base takes its own view on whether it wants to invest in container ships or dry bulk ships. They don't move in parallel, these two markets. Personally, I'm invested in both, but every investor has to make his own decision. And we saw that when we did the spin-off, the combined market valuation increased more than 40% in a single day just because we did the spin-off. We're not going to reverse that. Thank you very much for your wishes on Santorini. We all wish the best. Let's see how that earthquake phenomena develop.
New buildings versus second-hand.
New buildings versus second-hand. In times where prices fall significantly, we would go for modern second-hand these days. But generally, the newer the ship, the more fuel efficient it is, the more helpful we are to the environment, and we care about that. So EuroDry will not be focusing on older vessels, perhaps Euro Holdings, but EuroDry's focus will be on more modern ships.
Let me answer that one. I think we have our arrangements with Eurobulk at arm's length, at market rates or below market rates. So I think we're having a privileged position economically with Eurobulk, despite being a related party. There was a question about whether Eurobulk would lower any of its fees.
Yes, the fees paid to Eurobulk are lower than the average of the other listed entities. What do you think of the recent Stellar SPAC? I'm not aware of it. Did we finish?
Yes, I think that was the last question. Thanks everybody for the interest and participation. I hope, Nikos, you think that we had a fruitful exchange and provided useful information to our shareholders.
Thank you, Aristides and Tassos, for being with us today. As a reminder to everybody, this webinar will be available for replay on Capital Link's website and capitallinkwebinars.com, and also on our YouTube channel.
Thank you, Nicholas. I am happy you gave us this opportunity to have this discussion with investors, because I like receiving questions and trying to answer as honestly as I can. I think this is things like this will actually help us attract more investors and improve also the pricing of our stock. So thank you very much.
Well, thank you, Aristides and Tassos. And actually, one of the great benefits of this presentation is that you give the opportunity to your shareholders and investors to interact with you live. Look how many questions you had. And I think that is a platform that is particularly valuable, and not everybody offers it, and not everybody wants to take advantage of it. And kudos to you for doing that.
Thank you.
Thank you.
Thanks everybody again.